Hey everyone, and welcome to the Nasdaq Dorsey Wright podcast for the week ending on November 22nd. My name's Ian, joined again by Miles. Miles, good to be back across the table.
Yes, sir. How you doing? How you doing this
Doing
weekend?
well, doing well. It was a pretty cold start this morning in Richmond. Well, cold relatively. I think it's the coldest morning we've had, but only 36 degrees. Supposed to be 31 tomorrow morning, so we'll get below freezing.
And I'm sure next week it'll go back to being 65,
You
70 degrees. It
you
just
know, I
it
think
just
it's
flips.
supposed to stay a little bit lower. We'll
Oh, is
see.
that what it
Yeah, of
is?
course now it's going to shoot back up because I jinxed it on the pod, but
Yeah.
I'm ready for the cold weather.
Probably not me. What do you got going on for Thanksgiving? Anything fun?
I'm sticking around. Both families are in town for me and my fiance, so we get the joy of two Thanksgivings in one day. So
That is nice.
it'll be an eating
How do
marathon.
you make it to the second place? You
Uh, I
roll over there pretty much.
yeah, I roll very slowly. There, yeah, it'll be good. What about yourself?
We've got a bunch of family going up to. We got a mountain home. I guess you could put it in Basie, Virginia. So we got a going up there with gosh, it's like 3 bedroom house, and we got or two bedroom house with like four toddlers, like eight people, not including myself. So you're like, I think I'll be staying on the couch for for the night.
Hey, that's perfect. You can
But
just watch football and fall asleep right
I
there.
suppose,
There
right?
you go. Yeah, and then coming in, I mean, it seems like there's been a lot of movement in the market over the past week or two, right? I mean, there's been a lot to talk about. Had NVIDIA report earnings yesterday. We can get into a little bit of that. But I think when you look at the default chart of the S&P 500, we're recording this podcast on the 21st, so on Thursday morning. At this time, we've not seen a chart movement on the S&P chart. It's been sitting at an all-time high since November 8th, almost 2 weeks that we haven't
Right.
seen a chart action. I would not have thought that if you had just asked me, have we seen a chart action in the past 2 weeks?
No, you wouldn't think that. I mean, but I guess you could, silver lining is you haven't seen chart action in the past few weeks, but you've been at all-time highs. I think you'd rather
Right.
see right that than not seeing chart action for quite a while and being at all-time lows.
I mean,
But
yeah,
you
100%.
know,
I mean,
but
yeah, and all-time highs, I mean, are nothing new
right,
this year. We've seen it be at all-time highs, consistently making new all-time highs. Good thing to see it at all-time highs, three consecutive buy signals. But I mean, the thing we talk about, the S&P was getting overbought, right? And it's like,
right,
well, you can normalize in two ways. You can pull back in price, so you'll see the price reverse down in a column of those,
right,
or you can pull back over time.
right.
We've done the latter. We've gone from an overbought posture for the S&P to 40% overbought, which is not what we would consider to be extended. So I mean, we'll see how things shake out. We'll see how it shakes out over the next kind of few days and few weeks. But I think that's a pretty interesting deal to note, and maybe not something everyone expected after the election week that we had a couple weeks ago.
Yeah, certainly not. And I'll offer the kind of other side of that coin. Now, the technical picture is actually still much better than it was as we opened up the year, but we have seen a pullback in price for small caps, right?
Right.
They were heavily overbought. If we were calling the S&P 500 heavily overbought, we've seen the Russell 2000 move back down out of heavily overbought territory, now testing some older resistance at around that 2300 mark. So again, things are still looking constructive, but the other side of that coin, either just not moving at all or at least pulling back a little bit in
Right.
price.
You see, but that's still, I mean, looking at the Russell 2000, just the normal default chart, that's still a healthy looking chart.
Yes,
You saw a
exactly.
sharp rally up to multi-year all-time high or multi-year highs, not quite all time. And then a pullback, like you said, to right above that prior annual high around the 2300 mark. You're at 36% overbought versus the 100 almost percent overbought we were a couple weeks ago. I mean,
Right.
that's a pretty good looking chart too.
Now, I don't want to get us too sidetracked. I know that we've got stuff to talk about,
Yeah, I mean
but
that's
do you think that failing to move to new all-time highs for the Russell 2000 there, do you think that's a symptom of something of a larger issue? Of course, different buyers and sellers than what we had in the market years ago when we printed those all-time highs for the Russell 2000, right? So the buyers and sellers aren't quite the same. But do you think that would it have been more constructive? I guess this is a loaded question. The answer is definitely yes. But would it have been more constructive to see us break past that and ultimately fall back down? I mean, how concerning is a lack of all-time highs for the Russell 2000 to you?
I mean, so we got to, just for perspective, we got to 2440. All-time chart high was 2449. So
Right,
we were literally one box away from an all-time high, right,
right,
on the chart. I mean, going back to November of 2021, so for 3 years. I would have been more concerned if it shot up to new all-time highs maybe on the first go, because we were at 100% overbought. So seeing it get into overbought territory, you're still in three consecutive buy signals. You're still on a positive trend. You just pulled back from the rally highs, and if right now we're looking closer to reversing back up into a column of X's than it is to adding an additional O, which I think is another important thing to note. So if we see a reversal higher, all of a sudden that's another higher low,
Right.
and could be a healthier ascent higher. I mean, small caps have seen their fair share of sharp movement over the past couple of years.
Right.
I
Up or
think
down.
what we want is consistent movement, and that's
Right.
kind of what we're seeing now.
Yeah. Okay. I mean, it's good. It's good for perspective, right? I think a lot of us, when we're looking at these charts, we can get super hung up on the exact O, the exact X that is the top or the bottom, relevant support or resistance. What I've been trying to do myself more is look at ranges, right? We're not going to get a exact even number every single time. So I just wanted your perspective on the lack of that, and appreciate the thought
Yeah,
there.
no, I think it's a good question, and it's a good question at when we're seeing, okay, we got small caps close to all-time highs. We have the S&P just sitting at an all-time high, not moving. The natural question I think a lot of people lead it like, can it go higher?
Right.
Should I invest right now? And I think very timely, research analyst Jamie West put a piece in the report on Tuesday, I believe it was,
Right.
titled "All In versus Average In." And the general gist of it is, what are you typically better off doing? Investing, if you get the hypothetical scenario, you get $1 million from a client, are you better off to put it on the market right now? Are you better off to put half in and then average in the rest, right? I mean, what's the better route to go down?
I'll just take $1 million, to be honest.
I mean, I would take that too. Yeah, I'll definitely got some places I can throw that in the market.
But what should we do with it, Ian?
Well, I mean, when looking at it, we'll throw the chart up there on the YouTube for those that are following along. But for those that are listening, your average return, if you averaged in, right? So it assumes that you invest an equal amount of the portfolio in the S&P 500 each month over a 10-year period. The average performance is up 58%. Good,
Right.
right?
Not bad.
Not bad. Percent positive, 90%, right? Good. Your median return at 70%. Again, not bad. If you went all in, if you just invested it all in instead of averaging in, you'd be up 134%. It's more than double your average return. I
Right.
mean, that's pretty shocking to me. And it makes sense when you think about it, but the numbers are kind of shocking just when you look at it in the table.
Yeah, it makes sense. I mean, listen, markets go up, right? That's nothing that's particularly new, right? So if you use time value of money, you say that a larger investment today growing, you can have more time for things to compound.
Right.
So again, makes sense. This isn't necessarily anything new, but just putting some perspective behind how important investing now is. And then we talk, I mean, shoot, we talk quite frequently about time in the strategy, not timing the strategy. And that's kind of a similar vein to this. You are just consistently, allocating money towards, broad market, towards a specific strategy, whatever it may be. And, over the long run, that can pay dividends.
Yeah, absolutely. And I mean, the interesting thing I think to note though, and there's some other tables in there that go through like if you started your 10-year period at different years, you do see different returns over time. But I think you can also see that in the minimum return. So the other deal that was in that table was Jamie put in a max return for the all in or the average in, and then a minimum return. So again, averaging in or going all in at the beginning of each month. What is your maximum potential return over our entire look back period, back to 1985? And what is your minimum return for each? Maximum for the all-in strategy, 370%. Maximum for the average in at 144%. So your maximum for the average in barely beat the average return for the all-in, which is kind of shocking.
That's a powerful statement.
Yeah. And the other side of the coin, though, I think is something why maybe average in might be a good idea for some, is because in some time periods, your all-in strategy minimum return is down 40%. And I think that happened in 2000. 1999. If you started January 1st, 1999, you'd be at negative 35%, going the all-in route. And your average and minimum return negative 23%. So negative 40% versus negative 23. Obviously save yourself a lot of downside. You get a lot less movement really with the average in, because you're just not in the market as much. So you just see more reduced volatility, more reduced movement, reduces the upside, also reduces the downside.
Yeah, and here's one thing, maybe I'll just play a counterpoint to that. Well, not necessarily a counterpoint, just an additional point. The average in strategy is much more realistic, right? I mean, you're getting paid every 2 weeks or every month, whatever it is. You're getting, for most people in their working age, right? Averaging in is more realistic. Of course, you do have a couple of hypothetical scenarios. You get an inheritance, you find $1 million
Yeah.
on the ground. I think what's encouraging about this actually is while the all-in strategy is better, there's no doubt about that. The average in strategy is also quite productive as well. I mean, you look at your percent positive, your 90% in both scenarios,
Yeah.
right? So just speaking again to the counterpoint of that of, hey, both are
But they're
effective,
good.
both are good. Yeah,
Right.
you want all the
One's
money
better.
now,
Right.
right? Yeah,
Right. Right. I mean,
yeah,
but I think the point to kind of look toward, if you're looking at, okay, which one should I do now? It's like, okay, the clear periods that have been bad for the all-in strategy is when you're in a bear market.
right.
If you're in a bear market environment, or even if you can never call, we're not taking a shot at calling the top, right? If you're in a bear market environment, though, unless you're clear you're coming out of it or just after it, if you're kind of in a very turbulent market, maybe going all in is not the route to go because
Right.
the market could very quickly go much lower if you're in a bear market. If you're not, if you're in a typical bullish market environment, might as well just go all in.
Right.
It's kind of the takeaway that I see from it.
Yeah.
But
I don't have anything else to add there. I think that's I really like the piece. Personally, I enjoyed reading this one. So
yeah, I think it was good.
appreciate
And
it,
another
Jamie.
piece I liked was a piece that you wrote actually
Oh,
on
thank you.
Friday. So when we're talking about stuff that's at highs or at kind of breaking out to new levels, talking a lot about the major indices, right? You see like we said, Russell 2000 close, S&P added, momentum as a factor, also doing pretty well.
Right.
Stuff that was doing well is continuing to do well. And the RS spread, as you identify, is a pretty good way to kind of track that.
Yeah. So in the piece, I kind of called this momentum's X factor, right? So all of us are always, all of our Dorsey Wright strategies are going to be focused on momentum, but momentum, I guess the question is, well, how do you know when momentum's doing well, right? And the answer to that is when the difference between winners and losers is high, right? When the dispersion between, your relative strength winners and your relative strength losers is great, that means momentum has a better chance of snagging a hold of those winners and avoiding, perhaps more importantly, avoiding those guys who just quite frankly suck, right? And so what we've done, and this is on the site, you can type it in, is create a calculation that helps display that, and that's RS spread. So again, the higher that calculation is, the wider the dispersion between your RS winners and your RS losers. And in 2024, as we've kind of come back or wrapped up the year, that spread is at multi-year highs again.
I mean, yeah, what highest level we've seen since 2022?
Yeah, highest level since 2022. And I will add here, it's not necessarily indicative that markets are going to go up, right? Let's see if I can put this in context. A high RS spread just says that you are in a market environment where momentum has the chance to pick up what's doing well and avoid what's doing poorly. To that point in 2022, right? 2022 was a bad market environment, but energy was doing well, technology
Right.
wasn't. So the RS spread was high.
It's the magnitude of the distance between it, not necessarily the direction of which those two are going, right?
Exactly.
So you
Yeah.
can
Thanks for
see
that.
like both could be going down, but if
Yeah.
one's going down 1% and the other's going down 30, then that's a very high RS spread.
Yes. Thank you.
Yeah.
That's definitely what I was trying to
I,
say.
I'm good at I'm good at speaking down. So
And then you
speaking
can
to
get
my thought level.
the exact opposite is true in 2023, right? So markets were strong in 2023. Momentum ended the year in the green, but momentum wasn't as
It had a
strong.
rough year.
Exactly. It wasn't as
Yeah.
strong in 2023. So again,
And historically weak, kind of from what we
yeah,
saw to start off the year. I mean, you can see it on that chart. We'll throw the chart up again on the YouTube for those that are following on YouTube. For those that aren't, I mean, we moved from in November of 2022 RS spread of 17.5 all the way down to by February 13.25. I mean, that's a 4% plus move is extremely rare to see in that short of a time. Sometimes we've seen that quick of a move to the upside, but to see that quick of a drop in the spread, to see everything kind of moving in the same direction that quickly, not good for momentum.
yeah. I mean, it was just a perfect storm. I remember talking about this with I think it was David or maybe it was Tuz on the podcast, something like this.
Yeah.
But I mean, you just enter 2023 overweight energy and underweight technology. That was just a bad shake.
Yeah, just did not work out
And
well.
then you just kind of saw that dissipate over the course of 2023 into 2024, and now we're excuse me, now we are where we stand today, which is financials are an overweight, industrials are an overweight, technology has fallen off a little bit, but remains an overweight, and that dispersion is really wide. So think about your laggards. Energy is it down there towards the bottom. Elements of healthcare are down there towards the bottom. And I'll also add, right, industrials, financials, and well, not technology, but industrials and financials, they are big enough weights in the S&P 500, but they're not the biggest weights like technology is. So again, I think that's a tailwind too for momentum when you can get areas outside of the core of the market doing well.
Yeah, I mean, financials continue to be very strong. I mean, if you're looking at, I mean, many broad representatives, we obviously saw a lot of kind of tailwinds on the back of the Trump trade, but you still have like XLF. It hasn't changed down into a column of those. It's still a little bit overbought. 5.66 fund score up 31% year to date. Up on a stem, maybe we'd like to see a little bit of normalization there, like some of the other areas of the market, but it's continuing to hold up and continuing to look very strong. Again, I would have thought it would have pulled back by now.
Yeah. Well, and a more sensitive, just trying to get us any type of support there. If you pull it up a 25-cent chart on that one, 4 consecutive buy signals, more localized support in the high 40s there.
Yeah.
So, you have gotten a little bit of a pullback. Again, that just speaks to pullback over time. So I guess we'll have to see.
Yeah, and we'll see. But as long as that kind of spread continues to go up, right? Again, you could see a little bit of a pullback, but maybe it pulls back less than some laggard areas. I mean, that you'd still see that spread continue to kind of go higher. So that's definitely going to be an important thing to watch as because I mean, in 2022, when we saw like that big sharp move up at the beginning of November, we saw a lot of action on that momentum chart that RS spread chart over the last 6 weeks of the year.
Right.
We haven't seen that play out over the past couple of weeks, but I think that'll be a pretty important deal to note to see if we see similar action.
And momentum typically does the best. I mean, markets in general do the best in the fourth quarter of the year as Santa Claus comes and brings presents for all of us.
Yeah,
but
hopefully.
Momentum is the same exact way, right? You have I don't have the graph right in front of me, but we've done tests that momentum is by head and shoulders above the rest of the quarters in the fourth quarter. So again, that's another kind of seasonal tailwind.
And that makes sense because of chasing, right? I mean, if you have markets that are up 20, 30%, areas of the market up 20 to 30%, all of a sudden you get in the final few weeks of the year and there's career risk for investment managers to say, I gotta go up. I gotta put the money where my mouth is, right? And kind of actually go out and buy stuff and keep the job for the next year, right? And so I think you see a lot of that going on.
Because they're buying what it has worked.
Right. They got to catch up.
Yeah. There's no way they're going to go buy something that's down 30%. They go into the new year and somebody asks, what the heck are you doing buying something that's down 30% over?
Right. Right. Yeah.
So there's extra demand at the end of the year for these names that have done well.
Yeah, exactly. And I think, that'll definitely be a pretty important deal to note as we go through. I know we had some other stuff that we wanted to hit on, but maybe for the second time, we saved that for another podcast.
Yeah, I don't think we're going to be with you all next week.
We probably won't. Markets are closing early on Friday. So typically when markets close early, we don't have the podcast that comes out there. We'll let everybody enjoy their Thanksgiving turkey without listening to us talk.
We could do a Thanksgiving when we have the whole crew Zoom in. And we're all eating turkey, and we're talking about.
I'll zoom in from my second Thanksgiving dinner. How about that? That'll certainly be a productive conversation.
Oh, geez. All right.
And with that, thanks, Miles, for hopping back in and or letting me hop back in. I guess you've been much more consistent on here than me.
Well, of course, it's always a pleasure, Ian. Appreciate you all spending the time with us here, and we'll catch you on a few weeks.
All right, thank you.